This is level 1 of the CFA program, the topic on fixed income and the reading on fixed income securities defining elements. This is the first in a series of fixed income readings and really serves as an introduction. And you'll see the learning outcome statements. There's a lot of define and describe. But let me go ahead and start by trying to provide you with a solid foundation of addressing not just the LOSs in this reading, but then the LOSs in some future readings. So let's look at 3 questions. Let's ask who issues securities. Let's ask what do those borrowers do with the capital? And then finally, let's ask what do investors get out of being a bondholder from those issuers? So let's look at that first question. Who issues bonds? Well, governments, of course, issue bonds, and businesses issue bonds. So we'll take a look at corporate bonds and government bonds. What do those entities do with the capital? Well, corporations use it to primarily finance the investment in wealth-increasing projects, although the proceeds can also be used for other things like mergers and acquisitions and maybe to pay a dividend and maybe to change the capital structure on the right-hand side of the balance sheet. Governments issue bonds in order to finance their budget deficits. Now, the third question, what do bondholders get out of lending capital to these entities? And that's pretty much the focus of not just this reading, but then the future readings here in this topic series. But what investors receive is an explicit promise from the issuer that has 2 components. The issuer says something like, hey, I promise to pay interest and I promise to pay principal. Now, a lot of times those interest payments, and they're going to be called coupon payments, those interest payments are fixed, but they don't have to be. And then the principal amount in almost all cases is going to be $1,000 of a par value. And as you look through these LOSs, there's describe and compare and describe. What are we doing? Basic features of a fixed income security. We'll talk about the contract. We'll talk about covenants. So once again, this is really just an introductory reading. However, if you know and you learn and you understand these LOSs, excuse me, then this will lead you into success to future readings. All right, what is a fixed income security? So what did I say earlier? Just a moment ago that a bondholder receives interest in principal. So notice what we have in bold there. Provides a return in the form of fixed periodic payments. So look down at the bottom of a timeline there. There's time period 0. And so at time period 1, 2, 3, and 4, and 5. So this is going to be a 5-year bond. And this is what we know about fixed income securities is that they have a fixed maturity date. There's an ending date to the bond issue. Lots of corporations and governments issue bonds for 10 years or 20 years or 30 years. But, in recent past, and I'm going back to, maybe the 1990s, there are companies that issue 40-year bonds and 50-year bonds. In fact, 2 companies that you probably have heard of, Walt Disney and Coca-Cola, issued 100-year bonds back in the 1990s. And so what does that promise involve? So look at the bottom illustration down there on the timeline that this bond is going to pay $40 every year for, in this case, 5 years. But if it were the Disney bond, it would be $40 for 100 years. And then on the maturity date of the bond, the bondholder will receive the final coupon payment or the final interest payment, and then the return of principal, which is why we have $1,000 plus the $40. Now, notice back on the way left under time period 0, there's a minus sign in front of that 1,000. That's going to be the price of a bond. And I think it's two readings ahead, maybe it's 3 readings ahead from what we're doing today. This reading is called something like, hey, how do we value a bond? And this is a good time for me to introduce it. We're going to value a bond just as the present value of the explicit promise, the present value of the coupon payments and the present value of the principal payments. So I'm going to have you get out your calculator right now with me, right? Get out your financial calculator and let's go ahead and work through this just quickly. This is not part of the LOS here in this reading, but it will be in a future reading. So the earlier you learn this, the better. So what I want you to do is I want you to find those 5 time value of money buttons across the top of your calculator. You know, they read things like PMT and FV and I. So let's do this. Let's do the 40, right? Let's do 40 and hit PMT. And that's our coupon payment. That's the ordinary annuity. Let's hit 1,000 and let's hit future value. And let's do 5 is N. And then we need an I in here. And what's happened in this question here on the slide is we haven't really given you much of an I, but let's go ahead and just assume that this I is 4%. So do an I, so do 4 of I, and then we're going to solve for present value. And let's just hit present value, and lo and behold, what do you get? Oh my goodness gracious, you get $1,000. So that's the price of this fixed income security today. Now, I'll go over some really, really good examples in future slide decks. But for now, let's remember that the price of a bond is simply the present value. So price and present value mean the same thing. The present value of those future cash flows. Now, let's quickly go through some of these bullet points here, also called debt securities, right? Fixed income, bonds, debt securities, right? We know that. The payments of a fixed income security are known in advance. Of course, when Coca-Cola or Walt Disney issues this bond, they'll say something like, hey, we're going to pay you 4%. That's called a coupon payment. A 4% coupon rate will pay you $40, 4% of $1,000 every year for 100 years. Now, in this case, it was just 5 years. So when you read, as a bondholder, when you read the prospectus or look at the indenture, you'll read all of these terms: 100-year bond, 4% coupon. All right, who are the issuers, right? So this is what we said. Issues can be governments, corporations, other legally recognized entities. We'll talk about them in just a second. And they can be these supranational organizations, so sovereign governments, both at the federal level and at the local level. But then oftentimes there are groups of organizations between and among countries that get together that can issue bonds. So what they do is they say, hey, you know what? We need a bunch of money. Maybe it's 100 million, maybe it's 5 billion. And what they do is these issuers appeal to bondholders throughout the world. And they do this in increments of $1,000 so that you and I can afford to buy any kind of a bond. So just think of this bond issue as a loan. What do you and I do? You know, we go down to the bank and we borrow money to buy a car and to buy a house and to help our children pay for their education and all sorts of other things. Well, corporations do the same, but they issue a bond so that they can raise huge amounts of capital. I mean, imagine if we wanted to borrow. Let me just come up with some crazy number here that even Hollywood people couldn't imagine. You know, suppose we wanted to borrow $6 billion to build a house. You know, I can't even imagine what that house would look like. But if we went to one bank and said, hey, can you lend us $6 billion to buy the house? Even if we were super wealthy, right? The bank would say, gosh, that's way too much. We'll lend you $200,000. So then we'd have to go to a whole bunch of banks to raise that capital. And this is what the bond market does for us. Here we go. Maturity. You already know this. What's that second bullet point read? Typically range from overnight. Now, overnight securities, those are short-term kind of fixed income securities, but 10 years, 20 years, 30 years, or all the way up to 100 years. Now, here's a good definition. So money market securities have a maturity less than 1 year. And money market securities typically do not pay a coupon or an interest payment. But those that mature in 1 year or longer, they typically do. And there are some crazy bonds out there that go against everything that I've said here in the past few minutes. These are called perpetual bonds. In England, they call them consols. They were fairly popular, maybe 50 years ago or so, but I don't know that The consols are issued much anymore because there is no maturity date. They just go on in perpetuity, kind of like a share of stock. Let me tell you a quick personal story. In 1981, when I was sitting in my very first financial accounting class, a professor, and by the way, I was in such a big class that there were, I don't know, maybe 3,000 people in this gigantic auditorium. And the professor kept saying something like, okay, a bond has a face value, and a bond has a principal, and it has a maturity value, and it has a par value. And he kept using all these terms. And I was thinking, man, this is a lot of terminology. And I thought, why does he keep changing? They all sound like they're $1,000. And I was tempted to raise my hand, but back in those days, I was a little bit shyer than I am now. Plus, there were thousands of people in there. So I read the book. Read the textbook. That's always a good thing. And it said, hey, these things pretty much all mean the same. And in almost all cases, that par value is $1,000. Coupon rate, this is what I was saying. Think of the coupon rate as the interest payment. We're going to get the coupon payment from the coupon rate. And what did we do back here? Let me just go back quickly here. So notice we have $40 every year for 5 years. So this was a 4% annual coupon rate. You take 4% times the 1,000 to get the annual coupon payment. And that annual coupon payment is the interest payment. Now, notice that second bullet point down there. Most bonds, they're kind of considered conventional bonds. Most bonds pay a fixed coupon rate. But organizations, corporations, and governments, they don't have to pay a fixed 4% for 5 years, or Disney doesn't have to pay a fixed 4% for 100 years. I mean, they could make it up. They could say, look, I'll pay you 2% first year, I'll pay you 12% the second year, I could pay you 40% in the third year. But bond issues typically aren't that crazy, and so they're typically fixed, but they can also be floating. And look at the bottom arrow point. Floating rate consists of a market reference rate plus some type of a spread. And that market reference rate historically has been LIBOR, the London Interbank Offered Rate. But I'm guessing that many of you know about LIBOR and the scandal. And so we're moving away from LIBOR and we're moving towards other kinds of market reference rates. One of them is the secured overnight financing rate, sometimes referred to as SOFR. And there are lots of other rates out there. I mean, I could come up with my own Jim's reference rate if I wanted to. But essentially, those reference rates are short-term rates that involve somehow bank-to-bank loans that probably have a very short-term maturity. So we start with that rate, and then we add some kind of a spread that reflects things like, maybe default risk on the bond. And we'll talk at length about that in future. Now, remember when I had you get out your financial calculator and we computed that $1,000? We hit 4 for the I. Well, we need to distinguish between the coupon rate, which gives us the dollar amount of interest, and what is known as the yield to maturity on the bond. Now, in the case that we just did with our financial calculator, we had a 4% coupon rate and a 4% yield to maturity. 4 and 4, that's why the price of that bond turned out to be $1,000. So let's go ahead and define this yield to maturity on the bond. It is, oh my gosh, didn't we do internal rates of return back in our time value of money stuff? So a yield to maturity is really just the IRR that forces that present value of the bond, the price of the bond, to equal to the present value of all of those expected or promised payments. And that's called the yield to maturity on the bond, which is a function of risk, let's say. And we'll talk about all those different kinds of risk. But what happens to yield to maturity over time? Sometimes it goes up and sometimes it goes down. That in and of itself causes the price of the bond to change from that original $1,000 that we computed just a few moments ago. Now, don't get yield to maturity confused with current yield. Current yield is simply taking the annual coupon payment divided by the price of the bond. That's called the current yield. So think of the bond's price. That's the current price, right? That's the market price. So current yield, you take the fixed coupon payment and put it over top of the current price, and you'll get current yield. And this is a great exam question. I do this all the time to my students. Make sure that students and you candidates know the difference between coupon rate, yield to maturity, and current yield. Now, remember what I said at the introduction. I said something like, what the issuer does is make an explicit promise. And I picked that term specifically because the explicit promise has its basis in legality. And so what we call this bond indenture is the legal document that outlines the obligations of the issuer. And so pretty much the document, I mean, it's, you can read these things. They're thousands of pages long, not quite thousands. I exaggerate a lot and embellish, but they're long documents. But somewhere in there, they have the coupon rate, the maturity date, and any right of the bondholder, which involves some of those embedded options that I talked about earlier, or some other kind of features that we'll do here in a slide or two. Yeah, so notice what happens down there in that bond, in that illustration that we have. So over on the left-hand side, we have the issuer, right? The corporation or the government entity. Over on the right-hand side, under the blue, we have the bondholders. Those were kind of us, thinking about us as the bondholder. And so this is the image that I give my students all the time. I say, hey, this is what the executives of a corporation do, or what the representatives of a government do. They pick up the phone and they call the bondholders and they say, hey, can you lend us a bunch of money? We're going to do this and this with it, and I promise to pay you coupons and principal amount. And so I give my students this kind of, an image that illustrates the intimate relationship between the issuer and the bondholder. But then I tell them that, of course, this really doesn't happen. I mean, the executives don't pick up the phone and call the bondholders because there's a middle person in there. So there's the trustee. It's probably some kind of a financial institution that does lots and lots of stuff. And inside of those trustees' obligations are to making certain that the issuer over on the left-hand side does all the stuff that is outlined in this legal document, and that the bondholders get all the stuff that they are duly and legally the rightful owners of. Let's see, a plain vanilla bond has a standard template. Yeah, sure, that makes a lot of sense. Exotic bonds have tailored and long indentures. So this can be, what did I say earlier, 1,000 pages. Well, I promise you, unless you're a lawyer, you don't want to read all these things. But it's probably worth it to do a quick search just to take a look at this for 10 or 20 seconds. All right, so what was that first one? Legal entity of the bond issuer. So we did all that. So it's the corporate legal entity, or it could be a holding company. Remember, financial institutions, a lot of them have what they call financial institutions, holding companies, or bank holding companies. And then look on that bottom right. Boy, we'll talk a lot about these special purpose vehicles or special purpose entities, where these corporations, they create this new legal entity and they throw some assets in there, and then they use the assets as collateral to issue a bond. And so the bond indenture has to tell us all about that. This is a source of off-balance sheet financing that, it's really a cool source of financing. It really does lots of really great things to transfer risk. The problem is that we need to make sure that we know everything that's going on about that. Think Enron. Those of you who are old enough to live through Enron, somewhere around the year 2000, they had a bunch of these special purpose vehicles, and they told us that they threw a bunch of assets into this thing, but they didn't throw any assets in there, and they ended up borrowing a lot of money, and they faked us all out. All right, source of repayments. All right, you ready for this? So corporations issue bonds. What did I say earlier? To invest in wealth increasing projects. And so what do those wealth increasing projects do? Well, they generate cash flows. So corporations repay these bonds by the cash flows from operations. Now, governments, on the other hand, they have an interesting kind of a source of repayment. If this is a federal government, then what does the federal government do? It issues these bonds to, what did I say earlier, to finance budget deficits. Well, the federal government can always just raise tax rates and impose taxes on all sorts of people out there to repay these loans. And of course, that works down at the local level too. Here in the United States, we have 50 states, so states can issue bonds, and cities can issue bonds, and counties can issue bonds. Some countries call them provinces, and they have other names. But look at that second arrow point, supranational organizations. So what did I say earlier? That these are organizations that take components from different countries. These are supranational, so in between or among nations. And I always tell my students about one of my favorite supranational organizations called the African Development Bank. And what the African Development Bank does is they issue a bunch of bonds. And I encourage you to go to its webpage, because they issue bonds to help all of the people who live in Africa. And so they have agricultural needs, they have water needs, they have social needs. And so they issue bonds, and these bonds have, they can have a fixed coupon rate, they can have a floating coupon rate, they can mature for 10 years or 20 years or 40 years. But what they do is they make capital available, and they make loans to individuals and other organizations who have these entrepreneurial ideas about how to improve the quality of life in the continent of Africa. And so how does the African Development Bank repay its bond issue? Well, through all of the loans that it makes and all of the programs that provide cash flows. And then skip down to the bottom. Boy, we're going to have great conversations about asset-backed securities. Now, this is probably an introductory concept to many of you, but asset-backed securities are a larger asset class. One security inside of this is known as a mortgage-backed security. I bet you know all about mortgage-backed securities from the financial crisis in 2008. How about collateral or backing? And so a lot of corporations, they can issue unsecured bonds. They can just say, you know what, we're big enough. We don't need to tie anything to a specific asset. But many corporations and many bondholders prefer that there is some kind of a backing. So senior ranked bonds, these are probably secured bonds that are secured with a specific asset. So you think of Walt Disney, what does Walt Disney do? What kind of assets? It has the theme park, right? And it has TV, and it has movies, and it has production sets, and whatever else goes into that. So they could issue a bond and tie that to the asset, so that if Walt Disney couldn't repay the loan, then the bondholders would force them into bankruptcy court, and the judge would say, okay, you now have possession of a theme park. And the bondholders don't really want to run the theme park. They would sell it. Different types of collateral in terms of the legal document inside of this indenture. Collateral trust bonds, mortgage bonds, equipment trust certificates. Those equipment trust certificates were pretty much the origination of collateral. These go way back, 150 years ago to the railroad industry inside of the United States. And there are tons of these today because, like the airline companies, they pretty much use these equipment trust certificates because they don't really want to buy the entire airplane from Boeing or whoever else makes the airplane. What they do is they put this airplane into a trust, and then essentially what the airlines do is they lease the asset and they repay it, and there's some provision which they can actually take ownership of the airplane over time. That's an equipment trust certificate. So mortgage, property, and covered bonds, collateral trust. Just think of any kind of an asset that an organization has, that a corporation has, that can be used as collateral. Credit enhancements. These are super cool things. Let's suppose I issue a bond for let's just say $1 million, and I use an asset that I have that cost me $1 million. I mean, that makes sense, right? Well, the bondholders are going to take a look at me, and then they're going to take a look at the asset, and they're going to say, boy, there's some risk involved there. Maybe it's not nearly as collateralized as we would like it to be. So the bondholders might look at me and they say, hey, Jim, you know what? We want more collateral. We want that asset. Plus we want a bunch of other assets in there. So this is called overcollateralization. And here's the example that I always give my students. And I've used this in examples for level 1 and level 2 recordings. But I tell my students, I say, look, let's go back to one of my favorite movies from the old time days, and maybe a movie that you guys have seen. I'm referring to the Pink Panther movies. So you remember Inspector Clouseau was trying to find this stolen Pink Panther diamond, which was priceless. So imagine putting the Pink Panther diamond into a trust as collateral for $100 million bond issue or whatever it is. This is an example of over-collateralization. So when you get to the exam and you get to a question on this, think of Pink Panther and then give yourself a chuckle for Peter Sellers and Steve Martin, who are super funny in those movies. And I promise you won't get this question wrong, right? How's that for a loose promise? And there are other ways to do this. You can do credit tranching where you slice it into different tranches. We'll talk about that at some other recording. All right, covenants. These are really cool things that add value to the bond issue for both the borrower and the lender. So notice what we have there in that first point. Legally enforceable rules that both parties agree on. And so these can either be in the affirmative or in the negative. And so the affirmative, of course, the name suggests that somebody has to do something, right? And so the great example is when a corporation issues a bond and they say, hey, we're going to issue this bond and we have this terrific idea over here for a positive NPV project. We're going to invest it in this new product line. So we're going to use the proceeds to do this. And so remember we had that illustration in the middle for the trustee. So the trustee is going to make sure that the company borrows the money and then uses it for those specific proceeds. And then some other minor ones are something that sounds like, you know what, as a bondholder, we're trusting you with our capital, so why don't you trust us? Why don't you hire some really good financial accountants so that they can go through the financial statements and audit them and put their stamp of approval? So those are examples of positive covenants. But then there are negative covenants. And so if you're my bondholder, you might say to me, all right, Jim, we're happy to lend you the money, but we don't want you to do this and this and this and this. Because if you do this and this and this, then we might not get our $40 from that earlier example. Yeah, so look at the examples we have at the bottom. You cannot sell certain assets. Like that asset that's in the trust, that's in the collateral. You can't sell the Pink Panther diamond without our approval or without our knowledge. You can't take over another company. You can't pay a dividend, or you can't increase the dividend by more than 10%, or you can't do this, or you can't do that. So remember positivity and negativity. And that takes us through all these LOSs. This was super fun for me. I hope you guys enjoyed this, and knowing that this is really just the foundation for learning the next series of readings. So in future readings, we're going to take a look at some more of these details, but most importantly, we're going to learn how to price a bond and to price all of these different kinds of bonds. And then we'll talk about risk as well. So lay the foundation. So what did I say in that very first slide deck? Know the answers to the following questions. Who issues the bonds? What do they do with the proceeds of the bond issue? And then what impact does all of this stuff have on the bond holders? So thank you for watching and good luck studying.